Hello, this is Norma Noriega. I'm an insurance agent, Olivia, but I want to know more about you.
Hi, Norma. It's nice to meet you.
Nice to meet you.
My name is Olivia, and I am the mid market sales executive with Allstate Benefits out of our Phoenix office. And everything that we do is group self funded health plans. So, traditional self funding, level funding, as well as standalone stop loss. My specific area is groups 51 plus, but we go down to groups of two. And I guess I wanted to start out by asking, what has been your experience with group health so far? What do you know
Yeah.
about group health? What have you done in the past?
Well, to be honest with you, I don't know much, and that's why we're here, I guess, because I
Yeah.
want to learn more. We do the group insurance, and I say when I say we is because actually my business partner is the one that is doing that part of group insurance. I don't handle it much. I just send the census, and he takes it from there. So I'm pretty much just doing the like individual, like Obamacare and some other, things. But we do have some clients that have small, very small groups, and they want to know more about a group plan that is not as expensive or where they can save, a little bit more on insurance. And but to be honest with you, that's why I want to learn more about what you do, because this is important for some of our business owners that want to provide insurance to their employees. So can you explain a little bit more about what you do and how these plans work?
Yeah, definitely. So, when most people think of group health insurance, immediately what the first thought is a traditional fully insured plan.
Right.
So, with a traditional fully insured plan, you pay a premium to an insurance company. Those dollars go to the insurance company, and then in return, they pay the claims that you incur over the year. There's very little transparency to where those dollars are going. There's very little control over the plan designs. They might have a couple options that you choose from, but you're kind of at the mercy of picking one of their product offerings and giving them your money, and they take that in exchange. You don't see those dollars ever again.
That's right.
Is that fully insured model what you've had experience with in the past? Is that what you generally think of with group health?
Yes, and that's for us, I think that a fully insured group insurance works very well for people that have a lot of employees that have illnesses going on, because it does work for them because of the deductibles, the out of pockets, whatever. But I am not familiar with what you do or the kind of group insurance that you have or that you're offering through Allstate. So and that's, to me, it's intriguing how this works, because I'm so used to just hearing, as I started to work when I was like 18, I used to have the fully insured group in all the different places that I was at, and I've never heard of this other concept. And I think that is intriguing, but at the same time, I think it's really good for those groups or those employers that have very young, healthy individuals, right?
100%. And the fully insured product will always have a place in the market, like you said, for groups that have people who are sick, and they have populations that do need to get that coverage through that route. For some groups, it's the only option. But
Right.
more and more groups are cluing into the fact that there are alternative options out there, because the fully insured model isn't working for a lot of groups anymore.
Right.
With the Affordable Care Act, there was a lot of great intention behind the Affordable Care Act, wanting to make sure that everybody gets coverage that they need and getting coverage for people who maybe in the past weren't able to. But great intentions sometimes don't have the best consequences overall.
That's true.
One of the things that happens with the Affordable Care Act is when you're bringing in riskier people, which again, great that they're getting the coverage that they need, but because insurance is pooled risk, it raises the rates for everybody, whether that is a risky group or a really healthy group. And in addition, the Affordable Care Act put something into place called the medical loss ratio. And what that was supposed to do was limit the growth of insurance companies, because it essentially says that any dollars brought in by an insurance company, they have to spend 85% of them paying out on claims, and they can only retain 15% as profit.
Right.
But what that ended up meaning is that for the only way for a large fully insured carrier to grow is for them to see cost of medical procedures, cost from providers, claims cost rise, because the only way for them to make more money is for that 15% slice of the pie to get bigger.
Right.
So in turn, it kind of meant that for the large fully insured carriers, they're adversely incentivized to see healthcare costs rise.
Right.
And as we've seen since the onset of the Affordable Care Act, healthcare costs have gone up and up and up. And something that was intended to limit the growth of the insurance companies, they have grown exponentially since that was in place. And so a lot of people are kind of cluing into the fact that there are problems with the industry, and we want to find routes to solve them.
That's right.
So our solution to this is turning away from the fully insured model and looking at self-funding. So I wanted to ask you, like, what is your understanding of self-funding right now? Do you have kind of a high-level overview, or where are you at with self-funding as it stands today?
Well, self-funding would be like putting money aside, right? To on like an HSA or something where you are funding your expenses. Or explain to me, because
You're
I'm
all
getting
good.
confused
That's why
here.
I asked. That is why I asked. So with a self-funded health plan, essentially, instead of paying a premium to an insurance company and then they are paying all the claims on your behalf,
Right.
You are holding on to those dollars and you are paying a stop loss premium so that up until a certain point, you're covering any claims for your group. And if you hit a certain point, the insurance company covers any claims above that. So instead of, again, paying dollars that you'll never see again, you keep the money in your hands, but you put a cap on how much you're going to be spending on your healthcare.
Right.
In a average group, 4 out of 5 years, the group performs better than expected. So with a fully insured plan, the carrier's the winner because the group is performing better than expected. They're taking in the premiums and paying less claims than they were hoping to, taking that as profit. The only year that the employer would win is the 1 out of 5 years that they have a big claim or someone goes catastrophic or something really bad happens.
Okay.
And so with self-funding, you're moving that margin into the hands of the employer, where on well-performing years, the money stays in their hands. But in a bad performing year, they have that stop loss cap.
Right.
So for a large employer who has a lot of capital, they can afford to pay claims as they're incurred. This works really well. So they put a health plan in place, and for the group members, it doesn't look any different than what they're used to. There is a deductible, just like normal, max out of pocket, co-pays, co-insurance. The health plan looks exactly like any other health plan. But to the employer, they're paying the claims as they get incurred up to a certain point. And then insurance comes in and takes it from there. They still pay premiums. Premiums are only going towards the stop loss premium. So buying the insurance on that cap. So saying we're only going to pay up to this much, anything else insurance company covers, stop loss premium pays for that. And then admin fees for the administrator to administer the plan. So for large groups that have the flexibility and the capital to do that, it works really, really well. For small groups, sometimes they don't have the money to pay out claims as they're incurred.
I was going to say, like for smaller groups that they don't have all the money to be paying so much because, like you said, the the full covered plans, they usually are very expensive, extremely expensive. what I like about your explaining, so they pay up to a certain amount, and once they go above and beyond that, then Allstate will pay for the other claims. What if let's say that there's a group and they didn't have any claims throughout the year, but they, as you said, they are paying a monthly payment to Allstate or to the insurance. At the end of the year, is there like a way that they get back some of that money, or is there?
So in the traditional self-funded model that we were just talking about, the costs of the plan itself, that stop loss premium, the admin costs are comparably really, really low compared to a equitable fully insured plan.
Okay.
So if we're looking at a large group, we budget generally 80% into variable cost, or what we kind of expect them to pay out in claims, 20% into the fixed cost of the stop loss premium and the admin. So that 20%, the admin fees go towards the administrator, customer service, taking care of the claims, marketing fees, all of that kind of stuff, as well as that premium for the coverage they're getting in the case that Allstate would have to pay over the top of that. But that 80% chunk of what is expected that they pay stays in their pocket. So the benefit of that is they get time value of their money. They can invest it however they see fit for their business until a claim hits and they would need to pay it.
Right.
So those dollars stay in their pocket. For smaller businesses who maybe don't have that same liquidity, they if they got hit with a $20,000 claim, might not have the dollars to pay it immediately.
Right.
So like I said, we go down to groups of 2. Groups in that smaller range probably aren't going to have a bunch of money on hand to pay a claim as it's incurred.
Right.
So what we do in that situation is something called level funding. And level funding looks a lot like a fully insured model in that you are paying a level monthly premium. You know exactly what you're paying each month, no matter what the claims are. And a lot of times it ends up being lower cost than a fully insured model.
Right.
But that would go towards 3 things. So one, or not a third, but one of the 3 parts that payment would go towards is the admin costs. One would be the stop loss premium, and another would be payment into a claims fund. So funding a bank account to pay claims. In the level funded model, the benefit is that you can, as a small business, budget exactly what you're funding into this account every single month. The payment's the same every month. Whereas the traditional, you're paying claims as they're incurred. This is building up a bank account to pay claims. The nice thing about this is for a small business, like I said, you can budget exactly what you're going to be spending per month. It looks like a fully insured model where you're paying the same amount. January, February, March. And then the administrator pulls from that claims fund to pay any claims that come in.
Okay.
At the end of the year, you were saying getting money back. So at the end of the year, different carriers will have different percentages of the amount that you can get back of unused dollars. We give up to 100% of any unused dollars in that claims fund back to the business. And that's regardless of if they renew or not. So it works very similarly to a traditionally self-funded model in that any of those unused dollars go back to the business, but it's in the level funded program, them paying up front, as opposed to a traditional self-funded where they hold on to their money and pay them as they're incurred. I know I just rambled for a while, so if you have any questions, stop me.
It's really good. All the information is really good. One of my questions that just came up is like, do they have to qualify for these, to get these plans for a group? Do they have to have like mostly healthy people or anything like that? Is there a qualifying mark for this?
So there's not necessarily a qualifying mark on how healthy they have to be. However, their rates will change depending on the risk of the group. So for the state of Arizona, groups under 20, we do gather IMQs, individual medical questionnaires, and do medical underwriting because we underwrite based on expected claims. we want to set the group plan up for success.
Right.
We want to set them up to be getting a refund at the end of the year. So we fund those claims funds on a level funded plan at 125% of their expected costs. So building in a corridor there, even if they perform exactly as expected, there's still that 25% they would get back as a refund at the end of the year.
Right.
And if a group is riskier, then that 125% of expected costs would be higher.
Right.
For groups of 20 to 99, we don't need to gather individual medical questionnaires.
Right.
In the state of Arizona, we can underwrite based on the census and do expected claims through an underwriting process that way. And if we have claims data, if they're a large group and the fully insured carrier will provide it, or if they were already self-funded, we can get claims data that we can use to underwrite as well. So that's kind of why there's always going to be a place in the market for fully insured, because some groups, if they have an unhealthy population, might not be a fit for self-funding. But for the groups that are healthier, for the groups that want to kind of turn away from the traditional model, look at something a little more innovative, keeping those dollars in their pocket can be a really good solution.
Okay, and you can put these self-funded groups on more than 99 employees, or it's got to be, you can do it for 1,000, 3,000.
Yes.
Okay.
So we can do it self-funded in general. There's not really a cap. Our sweet spot on our level funded product is down to 2. But the sweet spot would really be like a 20 to 150 to 100 person group. Once groups get above that, then they start wanting to look at the traditional self-funding where they're keeping their money in their pocket, paying the claims as they're incurred. Bigger than that, groups might want to get just standalone stop loss and find their own administrator and their own pharmacy benefit manager and unbundle it. So as groups get larger and larger, there's a lot more flexibility and different risk strategies that you can put in place. But sweet spot for that level funded product would be like the 20 to 250 size range.
Okay, so that's more comfortable for either the group without having to go with a really, really big group, and for the companies as well, right?
Yes.
Yeah, you guys.
Yes,
Right.
definitely.
So
Having
that's
that
perfect.
level monthly payment.
Right.
People like being able to budget for exactly what they're
Exactly.
going to be able to spend.
Yeah, and I was asking that because usually when you have a huge group, usually it's mostly healthy people. I mean, you're going to have a few, maybe out of 200, maybe 5 are going to have problems, but that's what I usually find out just by writing individual insurance. I see usually the same 2-3 people are the ones that have a lot of things going on. So I get it. It's this is so cool. I mean, I'm learning a lot about this, and this is perfect because, as I said before, many people don't really think about these plans that are available for them, and it's something that we should be bringing up to our business owners, because some of them are like, I only have 2 employees or 3 employees. Some of them have 10. So something like this would be perfect.
Yeah, and it allows that level funded model allows a small business, like you were saying, to get the same benefits of self-funding that a large business
Exactly.
would. That's something that they maybe wouldn't be comfortable with or be able to financially do, but with the level funded product, now they're able to kind of reap those same benefits as a large company would be able to.
Exactly.
Another really cool thing about the self-funded plans is that they're fully customizable. So it's not like there's any one boxed solution that groups have to pick from.
Right.
Everything is a lever we can pull. So if they want their deductible a little lower, max out of pocket, co-insurance, co-pays, pharmacy co-pays, everything is flexible.
Okay.
So it lets us be very strategic about putting together a plan for a group that's a perfect fit for them, depending on what their priorities are, what they're looking for. If they want something that looks exactly like what they had before with their fully insured carrier, deductible, max out of pocket, all of that kind of stuff, or if they want something a little bit different, they get flexibility in customizing those plans.
Okay, so it's like if they had access to certain hospitals, then you can do that at the same time,
Yeah.
in these plans, like.
Yes. So there's a full suite of different options that they can choose for networks. So we have full nationwide networks they can use, rental agreements with Aetna Signature Administrators Network, Cigna OAP, Cigna PPO. So they can choose a network like they would be used to.
Okay.
We also have narrow network options like Cigna Local Plus here in Arizona, or Healthcare Highways in Texas is one, where it's just a smaller, cheaper network, essentially.
Right.
And then we also have a full range of reference-based pricing products, which instead of having a network, they pay based off of a percentage of Medicare.
Right.
And that's also a good solution for groups who, like you said, may be more unhealthy, maybe have higher claims, because it manages the cost of the claims instead of using top-down approach of a network discount, bottom-up approach of paying based on a percentage of Medicare. So we try to give as many options as possible. Like I said, customize flexibility. Groups can kind of
Very
choose
flexible. I
Yeah,
love
what
it.
they're looking at.
Yeah. Well, thank you so much, Olivia. I think I've learned a bunch right now.
Awesome.
So
Well, I'm glad.
that is great. I appreciate all you have shared with me. And I'm pretty sure a lot of people are going to learn so much about this too. Thank you.
Of course. Thank you for having me.